Merry Christmas, everyone. Right now, wherever you are in the world, things feel quiet. Too quiet. The markets are calm, the charts look frozen, silver hasn't moved much, and it gives the illusion that the storm has passed. It feels like the year is basically over, like nothing important can happen anymore. But the calm you're seeing is not safety, it's fragility. I'm recording this now because there's something happening beneath the surface that most people won't notice until it's too late. The financial media isn't talking about it. Brokers won't warn you about it. But professional traders know this period very well, and they respect it for one reason. This is when markets break. We are entering a very specific window of time, the days between Christmas and New Year's. In the futures world, this period behaves differently from any other part of the year. The rules change. On a normal trading day, markets are supported by experienced risk managers, senior traders, and deep institutional liquidity. Big banks, hedge funds, and algorithmic desks actively defend price levels. If a large order hits the market, it usually gets absorbed. But during this holiday window, those people are gone. Senior traders have flattened their books. Risk managers are offline. Decision makers are on vacation. What's left behind is a skeleton crew and automated systems running on minimal settings. Their only job is not to break anything until January. The result is a massive collapse in liquidity. Volume drops dramatically. Order books thin out. And when liquidity disappears, prices no longer move normally. Think of the market like a frozen lake. On a regular day, the ice is thick enough to support weight. You can drive across it, but during this week, that ice melts. It looks solid, but it isn't. When a large order hits a thin market, there are no layers beneath it to slow the move. Price doesn't step down or up. It jumps, it gaps, it teleports. This works both directions. A sudden sell order can punch the price down several dollars before a buyer even appears. A sudden buy order can launch price upward in a single candle because there's nobody standing in the way. That's why this period is dangerous. Not because nothing happens, but because anything can happen. History proves this. Major moves in silver didn't begin during busy trading weeks. They often started quietly during thin holiday sessions when nobody was paying attention. What looks like boredom on the chart is often pressure building, and today that pressure is larger than it has ever been. We are coming into this window with silver already up massively, sitting near record highs. Psychological resistance has already been broken. Above current prices, there are no trapped sellers waiting to exit. Everyone who owns silver here is already in profit. That matters, because markets fall when people are desperate to sell. This market has no desperation, only hesitation. At the same time, technical indicators are stretched. Sentiment is extremely bullish. Under normal conditions, that would suggest a pullback. But these are not normal conditions. Why aren't traders taking profits? Because physical silver is disappearing. Just days ago, millions of ounces were removed from major vaults. Registered inventory, metal that is actually available for delivery, dropped sharply. This isn't paper trading. This is real metal leaving the system. That tells you something important. The buyers taking delivery don't care about short-term price moves. They care about possession. They're securing supply before liquidity fully vanishes. At the same time, a massive price gap exists between Eastern and Western markets. Silver is trading significantly higher in Shanghai than in New York. That spread acts like a magnet. If Western prices dip too far, arbitrage buyers immediately step in and pull it back up. This creates a natural floor under the market. Now add geopolitics to the mix. While most people were distracted by the holidays, tensions escalated quietly. Shipping routes, sanctions, and military posturing are increasing stress across global supply chains. When fear enters the system, capital looks for safety. Normally, that money flows into the US dollar, but right now the dollar is weak. Interest rates are falling while inflation remains elevated. Real yields are negative. The Federal Reserve has effectively admitted it cannot fight inflation without breaking the system. That changes everything. When the currency loses credibility, hard assets absorb the pressure. Gold first, then silver. So now look at what we have. A holiday liquidity vacuum. Rising geopolitical tension. A weakening dollar. Vaults being drained. No overhead resistance. Algorithms programmed to chase breakouts. This is not a recipe for stability. It's a setup. In thin markets, algorithmic systems dominate. And algorithms don't think in terms of expensive or cheap. They react to momentum. New highs trigger buying, volatility triggers expansion. With no sellers, price feeds on itself. That's how gaps are born. This doesn't mean price only goes up. It means price becomes violent. You can see sudden drops, sharp spikes. Quick moves that make no sense. These moves exist to clear leverage. They exist to shake people out. That's why leverage is the real danger right now. During liquidity vacuums, price can briefly hit irrational levels, just long enough to liquidate overexposed traders, and then snap right back. If you're over-leveraged, you don't get a second chance. Being right doesn't matter if you're wiped out before the move finishes. For physical holders, the paper price may become misleading. You might see spot prices dip while premiums rise. Dealers understand supply realities better than charts do. For traders, patience matters more than prediction. The real signal won't come during the holiday noise. It will come when full participation returns in early January. If price holds strength after institutions return, that confirms the move. If price dips but quickly recovers, that confirms demand. Weakness that doesn't stay weak is strength. The mistake people make every cycle is selling into the quiet, right before the expansion. This market isn't ending a move, it's transitioning into the next phase. What we're watching now isn't chaos, it's a system under strain. And systems under strain don't resolve gently. Enjoy the holidays, stay calm, respect volatility, and remember, silence in markets is often the loudest warning of all.
Hello, my dear friends, welcome back to my channel and so welcome to my new video. Friend, right now, where are you are in the world, things feel quiet. Too quiet, the marks are calm, the charts look frozen, silver hasn't moved much, and it gives the illusion that the storm has passed. It feels like the years. It is basically our like nothing important can happen anymore. But that calm you saying is not safety. Okay? Again, but that calm you are saying is not safety. I am recording this now because there is something happening beneath the surface that most people won't notice until it's too late. The financial media isn't talking about the broken aunt, warn you about it, but professional traders now tease. Professional traders now this parade very well and they respect it for one reason. This is where marks break. So friend, this is its time is the big breaking. It's a bit important news breaking. Thank you so much.